Right. Thank you very much, Elizabeth, for the welcome, and thank you for everybody present. Today in the webinar series, we're going to cover 6 topics. So I'll briefly introduce myself and explain my experience in the topic of financing for e-waste operations. Then we'll be looking at several sources of financing, the types of financing, how to structure your finance needs. Then very important topic we'll be touching upon is company valuation and due diligence. And then last but not least, how should you approach potential investors? So briefly about me, I'm an economist, I'm not an engineer. I started working with Deloitte, where I quickly got involved into evaluating projects in emerging countries, mainly consisting of financial audits, due diligences, monitoring, and evaluation. And that's how I started working in emerging countries. Now, after a few years, I was kind of tired of writing reports with recommendations, and I decided I wanted to be closer to the action. And then actually I was one of the co-founders of World Loop. I was the first employee and project director of World Loop. And with World Loop, we supported about 20 e-waste recyclers, mainly in Africa and in Latin America, to either start up their business or to scale up their business. And the way we worked together with them is by basically offering financial support, seed money, to start up a pilot project. Then secondly, also by providing technical assistance, meaning we help the recyclers to help them structure their recycling processes. How do you set up an e-waste recycling plant? And also on the business side, so how do you finance for it? What should your business model, your financial plan, how should you organize yourself look like? And then last but not least, we negotiated as part of World Loop large framework agreements with recyclers around the globe, so that the complex fractions, the materials that cannot be recycled locally, could be sold directly to parties such as Umicore and other large recycling groups, basically cutting out the middleman, so that our recyclers would be able to benefit by receiving larger income from it. Then in 2015, I felt it was time for doing something slightly different. Although I still involved in e-waste recycling, but working more on the policy level. So back in 2014, I started helping mainly national governments on how to set up EPR systems, because that was one of my main conclusions, having supported over 20 e-waste recyclers, is that it's very difficult for recyclers to start up if you don't have a system for extended producer responsibility, which provides structural financing for recycling activities. So I was involved in setting up systems like this in DRC, in Mauritius, in Algeria, Benin, and Cameroon. Some of them made it to the actual implementation. In other countries, it remained a draft proposal for legislation. And next to that, I continue to follow up some of the recyclers that work before and other recyclers, but working on a one-on-one basis. And then in 2015, I decided I had supported a lot of entrepreneurs and to start my own recycling businesses. So in 2015, I founded a recycling company called Name Recycling, together with my current business partner and good friend Roblin. Today we have 3 factories, 2 in Cameroon and 1 in Gabon, processing about 1,000 tons of plastic per year. And most recently, I started up a new company, this time in renewable energy, where we are basically building hydropower plants to provide electricity up to 25,000 people per power plant. We currently have 2 plants that are operational and 2 that are in development. So this is just to say that I've had quite a lot of experience, let's say, both on the e-waste side and also in the financing, because that's been a large share of my responsibilities in the work that I was involved in since 2011. So because, yeah, of course, we are with a lot of participants in the call with different different levels of understanding of financing. So I'm going to do a quick introduction to the types of financing. So basically you have four types of financing. You have grants or subsidies, that's the same thing, which is basically money that is given for free and that you don't need to reimburse. And that is often given either by development agencies or by companies in support of a project. Of course, nothing is free, so they do expect the company or the organization to receive a grant to deliver certain outputs that have been agreed upon, but in principle, the money doesn't have to be reimbursed. Then the second form of financing is called debt or loans. So these are typically what you will get at the bank. So you go to the bank, you say, I have a plan I want to realize, I need a certain amount for it, and you reimburse it over a certain period of time, and as a compensation for being able to borrow that money, you pay an interest, and you pay the money back over time. Then the third form of financing is equity. Equity is basically share capital that is invested in a company by yourself and by potential investors later on in the project. If we look at the characteristics, also equity or share capital is money that doesn't need to be reimbursed, but the more equity, the more share capital you put in a company, the smaller your share becomes as a founder, and then the smaller the part of the profits you receive. So that's also, but it doesn't need to be reimbursed. It's just, it diminishes your shares of the future profits and brings on extra money to pay for the expenditures in the company. And then we have what they call hybrid forms, which are basically convertible loans, mezzanine financing, or quasi-equity. I will go a little bit more in detail on that later on, but just summarizing very briefly, it's basically a combination of debt and equity, or like a hybrid form of debt and equity. Then an important fact to realize is that there are different factors that will determine the amount that you are able to fundraise. And one factor that is influencing this is the maturity level of your company. So let's say if you are in the very early stages where you have an idea or you have a small project, you are only able to raise a small amount of money from other parties than yourself because you still have to prove the viability of your idea, of your business plan, or of your business. Then in the second stage, we come at what they call the seed stage. It's basically where you have developed a pilot project, you have some sources of income already coming into the company, and you are now starting to look at breaking even and starting to think about that's what they call the seed stage. Then the growth stage is actually the stage where you have passed your break-even point and where you are scaling up as a company, and where you basically need growth capital in order to extend your operations, improve the productivity, improve the capacity, and so on. And then the expansion phase is consolidating on that growth and going further. So if you look at the ticket size, that's a typical term that investment funds will use. It is determined by this maturity level. So in the beginning, you can count on fundraising, let's say, between $10,000 and $100,000. In the seed stage, maximum $500,000, and then in the growth, there you're looking at a maximum ticket size of 2 million, and then as of 2 million, you're in the expansion phase. The difficult part is basically the seed stage, because everybody is able usually to raise some funds. But in order to come at your break-even point, and in e-waste that translates usually in collecting a certain amount of e-waste and getting paid for that. And that's where most of the companies struggle. And it's also called what they call the missing middle, because that's the most difficult stage of a company to fundraise at. Then also another determining factor is the amount will actually determine the type of financing that you're looking into. So typically the first money you put in, it's not even mentioned on the slides, is share capital. And then you start putting in more debt, so more loans or convertible loans. And then as of the growth stage or the seed stage, then it's a combination typically of the three forms of financing. Then if we look at the different sources of financing, it's also really important to realize where you can get money. The first source of financing is what they typically call FFFs. That's the friends, fools, and family. So these are typically the people in your network, people that you know that believe in you, that are willing to put in some money in your company to help you kickstart your operation. At a certain point in time, when you have got a pilot project up and running, and you need to invest in certain type of equipment, or you need a bigger place to put all of your material, that's typically the moment where an angel investor will step in. An angel investor is typically a wealthy individual, somebody who has typically done very well for himself by starting up one or several companies, has been able to sell them, and has a certain amount of money on the bank account, and thinking about the fact that if I just put it on the bank account, I get a very low return on this money. If I invest a small amount of my total capital into a starting business where I really believe that there's growth potential, I am able to get a much higher return. The banks, I don't think I need to introduce them. So the model of a bank is basically putting somebody else, using somebody else's money, borrowing it in return for an interest rate. And then institutional investors, that's like a broad name that covers everything that is typically covered by the term investment funds. And so these are typically professional investors that have organized themselves, either in a company or combining several business angels together, but then investing together as a fund. And then last but not least are the private equity guys. So these are really the companies that are specialized in investing in growth businesses, and that also want a decent return for it, and for which it is really the core business to invest in a company at a certain moment in time, and then to exit again 5 to 8 years later, typically by multiplying the amount that they have initially put in. Then if you look at the types of organizations, to be a little bit more concrete here, I've of the investor scene in East Africa. It's a region I know very well because I currently live there. And there actually you see some of the organizations in the different categories. So the ones giving grants are typically, as I said, development agencies, but also accelerators and incubators. And so these are typically organizations that give you like an office space at a reduced cost, and that will typically help you to scale up your business by giving you technical and business support. This is always a very interesting ecosystem to be living in, because you are working together with other startups. These incubators or accelerators typically do a lot of linkages to investment funds. They will organize pitches and all kinds of training. So if you're looking at starting up or scaling up, it's always a very interesting place to have your office at. Then we also have for grant money at the foundations or corporates, the impact funds, and it's a very important term for you to remember because that is what you are doing with e-waste recycling. Impact funds are typically funds who invest in a company because they want to have a financial return, but at the same time also realize a social return. So when they invest in a business, they will look at the return in those two terms. They will say, okay, what am I able to gain financially? And what is the expected return when I invest in this company? And what is the impact that my money is having in the lives of the people in the country where we are investing? And this is a type of investing that is becoming more and more popular because especially in Europe, in the US, where interest rates on bank accounts are very low. So people feel actually more comfortable investing their money in projects which have a slightly higher risk, but where they also know that they're investing and hence having a positive impact on society. And then we have the typical funds like technology funds or private equity funds who are really, let's say, commercial investors. Then another topic that is very important is the question, when should you fundraise? It's important if you start thinking about getting external money in, you have to have something to show. So it's very difficult to fundraise if you only have a slide deck with PowerPoint presentation. You will need some kind of proof of concept in order to show to your investors that your idea is not just an idea, but is also existing and is feasible and is leading to the first results. So what investors typically look at when investing is, okay, do you already have some recurring revenue streams? Do you already have some customers, especially big customers like telecom operators or government institutions or banks for e-waste? These are really important contracts to have if you want to convince investors. And investors will also be looking at, okay, looking at the company where it is today, is it realistic to assume if I put in a certain amount of money that I'm able to multiply my investment by a factor of, let's say, between 5 and 10 over 5 to 10 years. If you are not at that stage yet, then it's really important to bootstrap. And bootstrapping basically means keeping your cost as low as you can and surviving on your own savings, on the savings or the money that some of your co-founders have put in, or also asking people that you know to help the mission of your company to work for free in returns for shares. Then also very importantly, if you're looking at fundraising, you need to start well in advance. Typically, and that's been my experience in all of the fundraising rounds where I've been involved, is 6 to 12 months is very reasonable. And don't count on doing it in any time less because there's a lot of things that come involved and investors are not investing just in a company. They are mostly investing in people. So they want to get to know the people, gain confidence. And then there's also the whole financial structuring, the legal structuring. These things, they are just take time. So do take enough time for that. An important question also is how much should you fundraise? Just as the importance of fundraising in time, it's important to fundraise at least for, let's say, your financial needs for the coming 24 months. So you will probably have a financial plan and a good idea about your capital expenditures or your investments. You know what the salaries of your people are going to cost. So based on that, you make an estimation for the next 2 years. And then if you can, please multiply it by 2, because in entrepreneuring is a business where there's so many uncertainties, where things can take longer. And then in the time that takes longer, you're burning money in fixed costs, or you can have a lot of unexpected expenditures, or you have to adapt your strategy all of a sudden. So try to fundraise more than you think you need in your financial plan, and update your financial plan based on that, so that you show your investors that you're being cautious. Also, very importantly, don't ask for too much. Know which phase you are in the growth of your company, and especially at seed stage, where I think most of you will probably be. Don't expect to raise more than $500,000. This is already an important amount that people don't like to lose, that investment funds don't like to lose. So they will always invest an amount depending on the maturity of your company. And then, last but not least, don't think that if you have finished one round, it stops. You can be at ease for a few months. Fundraising is basically a continuous activity. So even if you finished one round, start thinking already about the next one, knowing that it will take 6 to 12 months at least before you are able to close an investment deal. Then, after the theory, I want to get a little bit more practical. So let's take an example. How do you typically fundraise your company? This is a strategy that I've used that has worked quite well for me, but that I've also seen working with a lot of other companies. So I think it's a good practice to share, but of course the circumstances, depending on your business or your country, can differ. So typically, you will put in the first money as the founders. And especially looking at a business like e-waste recycling, you need a serious amount of seed capital to be able to buy e-waste, or to rent a warehouse, or to get staff to dismantle your e-waste. So I would say typically $50,000 to get started. That can be brought in by founders, or maybe with the help of a little bit of grants. But that's, let's say, the minimum amount you need for a proof of concept for a pilot project. And then if you have some promising results from your pilot project, then is the time to go to the family, fools and friends and try to raise more money by asking, especially fellow entrepreneurs, are a very good audience, people who are a little bit older than you, who have already had built up a successful business, and that may want to play a role in counseling, coaching you, and also investing some money. So that's typically the startup equity amounts, let's say 200 to 250 US dollars. Then with that money, if you've booked some results and you've been able to close your first contracts, now that is the moment to go to the bank or to other debt providers and say, look, we already have a share capital of $250,000. We already have some contracts, but we need additional money to grow. And then that's typically what debt investors will be looking at. They say, okay, what's the share capital and what is the value of those contracts? And based on that, they're able to do between, let's say, 50 or 100% of the amounts that you've already matched. So in this case, we have raised $250,000 in share capital, and we've been able to convince the bank to give us a loan of up to 250,000 US dollar. Now we have in total 500,000. Things are going well. Our collection volumes are increasing. We are starting to get near break even. And now we realize that we need more working capital to grow as a business, because we need to start investing in professional management, because it's becoming way too much work for yourself to be doing on your own. So you need a strong financial manager, commercial manager. You need to invest in marketing and communication, maybe get some additional technical staff on board, buy a truck for your collection. This is typically the stage where you're growing, and where you can start thinking about either getting external investors involved to put in more share capital, or to start thinking about a convertible loan. The terms and conditions of a convertible loan, what is it? Basically, it's the loan. So typically, an interest rates, let's say between 5 and 8%, a term of the loan between 5 and 10 years. And a convertible loan basically means that at the end of the loan, so at the end of the period, the investor can choose whether he wants the borrowed amount, if he wants it back, if he wants it reimbursed, or if he wants to convert it into shares in your company. And that can be a good thing or a bad thing. And the good thing for the investor is that he can choose. So if he's not fully confident about your business, or if he's short in cash, or for whatever reason he wants his money reimbursed, then he will ask to have it reimbursed. If he thinks, wow, I'm just scratching the surface here, there's so much more that I can do, then he will typically want to convert it into shares. For you, the conversion can also be interesting because your business in 5 or 10 years will be worth much more. So then the amount that they're putting in represents less share tomorrow than it represents today. So it's actually a pretty good deal in a lot of cases. And then if you have been able to put in a convertible loan or extra equity, then you can try the same trick again. And so you say, okay, now my share capital, because convertible loans are typically counted as share capital by the banks. So now you say, I've raised €1 million. So based on that, I can raise another 250 or 500 with the banks or with other debt providers. Also, very importantly, it's not possible in every country, but in the countries where it is possible, if you want to buy equipment, try to get it leased, because banks will typically lease equipment. So it means they give you the equipment in loan, but the equipment remains their property until you have paid it back. So even if you don't pay back, the bank will take your machines, and the machine actually provides the collateral in this case. Right. Then also, just to give you an idea of the ticket size in terms of the type of financing and the stage of your company in terms of maturity, in terms of investment by friends, family, and fools, typically looking between 10 and let's say $50,000. Then business angels will typically, in very early stage, invest maximum $150,000. Seed funding will go up to 500, and also, very importantly, crowdfunding is becoming more and more popular. I've actually also done 2 successful crowdfunding campaigns, and one was crowdfunding, so that's equity, and the other one was crowd lending. And it's quite an interesting model because next to getting money, you're also investing in marketing and communication. Because if you are able to raise, let's say, $150,000 in crowdfunding, you're not just having one investor, you're actually having, let's say, 150 people investing that are believing in you, that are supporting you. And what I've noticed is that, especially with banks and with other institutional investors, if you can show that even though the amount may not be huge, but if you can show that 150 people believe in your business, it's a very strong signal also for these investment funds that, okay, maybe there's really some potential here. And then looking more at the growth phase, venture capital, and then to 2 million in what they called round A. So that's really your scale up. And then at a later stage, round B, round C, that is really when you can fundraise more. So always know where you are, and depending on the source of financing that you're targeting, and make realistic assumptions in terms of what you can get from your investors. Then also a very important topic is share distribution. If other people are investing money in the form of share capital, it means that you are losing shares. And so if you started up a company as a founder, or as with 2 or 3 founders together, then you will typically have 100% of the shares. And then once other investors start coming in, then they will want a piece of the pie. And the earlier you allow foreign capital in, the bigger the percentage will be. So typically, if you are at your seed funding stage and you're talking to an investment funds that is investing, let's say, $150,000, $250,000, $300,000, they will at least want 30% of your business. Business angels up to 20%. So it may very well be that before you have left your seed stage, that you only have, let's say, 50 or 55% of your company. But I'm coming back to that later. That's not necessarily a bad thing, because you always have to think it's not just a percentage that counts, but it's also the size of the pie. So depending on the value of your company, if you own 100% of a company that's worth nothing, or you own 20% of a company that is worth 5 million or 10 million US dollars, of course, it's a big difference. So that's also really my advice. I've talked to a lot of other entrepreneurs that have been negotiating with other funds. Don't focus on the share that you're giving away, but focus on the size of the pie, because ultimately that's more important. And there are always ways to fix it later on and to make sure that the piece of your pie becomes bigger later in time. Then, very importantly, if you start attracting external investors, they will want to value your company. So it basically means determining how much your company is worth. And the way it works is very simple. If you do a valuation, or you have somebody else do a valuation of your company, and the conclusion of that valuation is that your company is worth $1 million US dollars, and they're putting in as an investor, let's say $100,000, then they will ask for 10% of the shares. If they put in $200,000 or $300,000 of a company that they think is worth 1 million, then they will ask for 20 or 30% of the shares. And that's a very basic but very important principle to realize. It's the value of your company that determines the shares percentage that you're giving away. How do you determine the value of your company? There are basically two methods. One is used mostly for existing businesses, where financial experts will be looking at what they call the EBITDA. That's your earnings before income, taxes, and depreciation of assets. So that's basically, let's say, your gross profits before you take into account your financial costs and your depreciations. So you multiply that with a factor of 4 or 5, typically for recycling businesses, and then you get the value of your company. But most of you will probably be in a situation where you are still starting up or scaling up, and where you may not necessarily have a positive EBITDA. If you have a negative EBITDA, then this method is no good for you, or if it's too low, if you're still early stage, then this is not a good model either. This is really the model for existing businesses that have been around for, let's say, 10 years. And then you take the average of the EBITDA of the last 3 years, and you multiply that with the multiplicative factor. So in most other cases, we will actually be using what they call the DCF methods. That's the discounted cash forecast methods. And it's basically your financial plan. So based on your financial plan, where you expect a certain quantity of e-waste to be collected, where you have budgeted for your costs, your personnel costs, your collection costs, your transport costs, and all of that. Based on that, the cash flow that you generate will actually determine the value of your company. But it's very important that this financial plan is realistic. And in negotiations with investors, they will always challenge your financial plan. So it's best to have a very conservative financial plan where you are backing up all of the assumptions. If you're saying that you're getting let's say $600 per ton for hard drives, then you need to be able to show that $600 is the historic minimum price that hard drives have been worth, and so you are basing your assumptions on that. If you are saying that you're going to collect 500 ton next year, then you should be able to show that this year you're already at 200 or 250, and that since you're talking to customer A and B, it's realistic to assume that one of these customers will accept a collaboration, and you will be able to double your collection volumes. It's never credible to assume that you're going to go from 10 ton to 1,000 ton in 2 or 3 years. That's not the way it works. So have a conservative financial plan, but do take into account that professional investors will also have their maximum valuation in mind. So they will typically say, for this kind of business in this kind of industry, at this maturity level, it's worth maximum 1 million, 2 million US dollars. And then it's really about negotiation. Then typically you will say that the company is worth 2 million. The investor will say it's worth 1 million. And okay, then you make a compromise and you say, okay, we agree that it's worth 1.5 million. Very importantly also, if you are negotiating with investment funds, you are negotiating with financial experts, which you are most likely you are not. So make sure that you are accompanied by the right people, by the right experts, and if possible, have an external expert do a valuation of your company. That gives us much more credibility than when you are doing it yourself. Because if you're doing it yourself, then obviously you have an interest in having it as high as possible. If there's been an independent expert that has been challenging all of your assumptions and that you agreed on a valuation together with him, then you are in a much stronger position afterwards to start negotiating with investment funds, because you can say, it's not me who's just saying that this business is worth 2 million. We had it verified by this reputable company, and they agreed with this valuation. Secondly, evaluation is also a subjective thing. So a matter of supply and demand. If you are only talking to one person, then you are not in a very strong negotiation position. Whereas if you are simultaneously negotiating with 2 or 3 funds, then you can start playing them out against each other and basically saying, oh, but we are talking to another fund and they agree with the valuation that we made. So then the negotiation you will have to do will probably be much less, and the valuation you end up at will be higher. So some lessons learned from my side. So I've been fundraising for the past 4 years continuously, I would say, for my various businesses, and before also together with other e-waste recyclers when I was still at World Loop. And so a few lessons learned. Valuation needs to be credible and taking into account the stage where you are. I sometimes get asked to confirm a validation, and if I see a company that is collected 50 tons, I know what they're worth. If I see that they are at 350 or 500 tons, I know what they're worth. So don't exaggerate, because investment funds will benchmark these kind of things with people who know what they're talking about. Secondly, and I got that wrong the first time, make sure you create a lot of stocks for yourself in the beginning, because you will dilute. That means your share in the company will become smaller. So make sure you have enough shares in the beginning, so that you, after your 3rd, 4th, or 5th round, you still have a decent amount of shares at the end. Then, very importantly, I think that's the most important lesson learned for me. There's a big difference between and the control you have in the company. So it doesn't mean you can have 20% of the shares and have full control of the company. That's perfectly possible, because the shares of the company, they determine the way the profits are distributed, but it is the composition of the board of directors and the way the board of directors functions that allows you to control the company. So in my negotiations with investment funds, I've always focused much more on the control of the company. and much less on the actual share percentage. And up until now, in all my businesses, I've been able to negotiate that as the founders, we still have full control of the company. Meaning we have 50% or more of voting rights in the board of directors. And then eventually, if your company becomes bigger and bigger and bigger, and it is eventually worth $5 million or $10 million, and you have only 15% left in your company, but you decide everything, then you are at the helm of every potential decision that will also influence the value and the profit distribution. So it's a very important thing. And if you want more advice on that, I'm happy to, you can always reach out one-on-one. Happy to give you a bit of more insight on that. So typically, in terms of the valuation, what I've always done is start up a company with share capital, and then making sure that the founders, the shares of the founders are valued at $100 for instance. So you put in $50,000. You say that the shares are worth $100. So that means that as a founder, you have 500 shares in the company. And then at the moment that external investors are coming in, then you do a first valuation, and based on that, you say now the value of the shares is $1,000. And I've never met an investor who has made a problem out of that. If you start up a company, it's just an idea, and once you start attracting external money, the fact that you multiply the value of your company by a factor of 10 is easily accepted by investors, as long as you can back it up by promising results from a pilot project or some initial contracts. Then, if the first contracts are starting to roll in, if the first larger investors or bigger amounts are coming in, and then you can say a year later or a year and a half later, now we do a new valuation of the company, and new investors are stepping in at $2,000. And then when you get your first big fish, a big investment fund, then you can do a new valuation and say we arrive at $5,000 per share. And then when you're really in your growth, you end up at $10,000 per share, for instance. That means that you as a founder, you have acquired your 500 shares at a cost price of $100. And if you stick until the end, then your 500 shares are worth $10,000. So you've got a very good deal going on. And that's also the way you typically avoid the dilution. So the fact that you bring in more share capital, but the price of the shares always increase, means that you're slowing down the rate at which you are decreasing your own share. Another trick is to create stock options. So at a certain moment in time, if investment funds are coming in, then you can start complaining to your investors and say, no, we as the founders, we only have 30%, 40% in our own company, and we've worked so hard, and we have given ourselves a low salary and so on. And that is actually the moment to say to your board, we want stock options as founders or as management. That basically means that you say, okay, if we get to a certain result, let's say next year we want to achieve 500 tons, and if we achieve that, then the company is giving us an option to buy extra stocks at a lower price than before, or at a cheap price. And then typically the board and the shareholders see that as a very strong motivator for you as an entrepreneur. So they will typically agree with it and say, okay, if you reach these targets, okay, then you can get more shares in your own company at a lower price. That will keep you motivated as management, as founders. And then last but not least, fundraising is time consuming. It is difficult. Even when things are going one big contract after another, it's still difficult. But when things are bad, are not going well, then it's even more difficult, because then if you're negotiating about the value of your company and your investors are saying, yes, but you've made a loss for the past 2 years, then it's very difficult for you to argue that your company is worth a lot. And so then you are in a completely different negotiation position. So that's why I say fundraising is a continuous activity, And especially if things are going well, if you've won an award, that's a great moment to fundraise and say, look, we have our operational results, but we're also now being recognized. We have just won this award, or there's just been a new investment fund that joined, or a reputable investor that has joined you as a shareholder. It is something that you can use as a leverage in your discussions with other investors. Then we're getting to the end. So what material do you need to invest? In the book, they typically say that you need an investment memorandum. I think I only wrote one in my life because I'm quite busy, and it's quite a big document where you basically present your whole business, and it's typically 30 to 50 pages long. But if you're explaining the basics of your company, especially in the beginning, then a PowerPoint presentation, in my experience, is at least as effective than an investment memorandum. It's mainly the development agencies that will require an investment memorandum, or the large professional funds. But if you're trying to convince people, then it's basically you and a PowerPoint presentation that will have to do magic. When you are presenting your business, always present it in a very logical way. So first, explain what is the problem, what is the solution that you are bringing. Don't forget, investors don't invest in a company alone, they invest mainly in people. So who is the team? Is the team equipped to be able to deliver that? And also there, and don't be hesitant to bring in extra people to make a bigger team. Don't try to do everything yourself, because you will actually convince investors more easily if you have a strong management team. That's really one of the key parameters that investors will be looking at. And then what does the market look like? Are you the only one active? How many e-waste is there being generated in your country? What does the competition look like? What have you been able to realize already? That's the traction. And then finally, what's your business model? How are you going to make money? Is it only by collecting e-waste and then selling it? Or are you providing also a service that people are paying for? Are you delivering marketing and communication services to companies? And so just explaining the model. And also investors, they get a lot of these applications, so keep it simple. The simpler you explain it, the more easily investors will be attracted to it, because people like simple ideas, things that are explained in a very simple way. They will say, okay, I understand this. If you get too technical or too operational, then you probably will lose your investors. You need to be able to present it in a straightforward way. Then your financial model is also really key. So that's typically an Excel model where you document your figures from the last year or from the last 2 years, and where you are making realistic assumptions with regard to the income and the expenditure for the next 5 years or something. Also your numbers, that's also something I noticed. If you get asked questions by investors and you always have to open your computer and go to your Excel, it's not a good sign. You have to know your numbers by heart. By 2020, I want to be at this amount of e-waste collected, at this amount of turnover. By this year, so that the key figures you have to know. We're breaking even in 2022. It's much more convincing, and also your PowerPoint presentation, and you don't have to present the whole financial model, but the key factors. Then also very importantly, how do you find your investors? How can you target them? Something that has worked quite well for me in the beginning is working through your network. I use LinkedIn a lot. Connections from people I don't know, but everybody I've met, I accept. So I know that, okay, some of these people, I've met them, I have a personal connection. So if I need something from them, I can send them a message, and since they know me, they will reply. So that's one way. And typically, actually one of my recycling company, my initial idea was to contact some of the recycling companies in Europe, ask them to invest in me, and then ultimately I didn't get any financing from that, but actually the CFO of one of those companies was interested and invested personally. He was actually my first investor in recycling. So use your network, especially second and third degree connections. You have somebody in common, you know that, or look for people that have investments or looking for opportunities or some terms like this in their LinkedIn profile. Then also know that there are networks of angel investors. So typically rich, successful people who have started up a business and who don't know what to do with their time and their money, they will join these networks where they are exchanging experiences in terms of investments and where they're counting on the networks to bring good investment opportunities to them. In Europe, there's the IBAN network, but there are typically these kind of networks in all countries. Then also, if you're talking to investment funds, I've never believed in sending emails to like info@email addresses. That just doesn't work. Or unless the organization is very disciplined in responding. I always try the personal approach. So seeing, okay, who is in charge of this fund? Who am I trying to address? Who is the boss there? And then reaching out to them with a personalized email, not with just a general email. That works so much more, so much better than general emails. Then don't forget crowdfunding. I've worked quite successfully with a French crowdfunding platform called Solilent. We have one also in Belgium called Spreads, but nowadays there are so many of these platforms coming up. So choose one that is in your country or that is investing in your country and leverage it because in addition to the money, it will bring you also publicity. Then another route is to see some of the companies that have an interest in my business. Are they interested in investing in me? It could be suppliers or partners, but then especially for strategic partners, you may not want them as a shareholder, but you would maybe want to propose them to invest in the form of a loan. And then also don't forget key individuals. Try to look, okay, who are the experts in this industry? Because if you bring in people who know what they're talking about and they are willing to associate themselves with your company, it creates a lot of confidence in your business. Or look also for other entrepreneurs that have been investing or that have been starting in a similar business, but that you also can exchange experience with. And I think that's been quite successful in the two companies that I founded. Is I always looked for people who didn't only put in their money, but who could also bring in real expertise. So one of our shareholders has a maritime shipping company. That's great help because we get good rates and if we have a logistical problem, then you can help us out with the former CEO of a recycling company. So if we have a problem with accessing the markets, then he may know one or two people that is able to call up. In my renewable energy company also, I've got the CEO of some successful renewable energy companies as investors. So it's not just the money, it's also the expertise people bring in and involve them, use them, because it can be worth much more than the amount they're investing personally. And also don't underestimate the value of network. If you have one person that is investing and he's enthusiastic about your business, then he may pitch your proposition to his network, to some of his friends or acquaintances. And that allows you to multiply your investors quite fast. And then as one of the last topics, don't forget you are fundraising, but also these investment funds or investors in general, they are looking at many opportunities at the same time. So this is a typical pipeline. You have a fund that has, let's say, 20 applications. Then they will do an analysis, a screening, a due diligence, and typically they will only invest in one out of 20 companies. So that means for you as a business, if you want one investment fund if you want to deal with one investment fund, you should be pitching to 20 or at least 10 or something to increase your chances. Because these funds, they look at a lot of things. They will look at you as a company, but they will also look at, does this investment fit in my strategy? Do I want to invest in this or that region or this or that country? Do I want to invest in this or that industry? Do I want to invest in this kind of company, looking at the maturity level? And so these are all factors that you may not necessarily have an impact on. And even though you have great discussions with the fund, in the end, it may be an investment committee who decides that they don't want to go for it because it doesn't fit in their investment strategy. So that's something you need to factor in into your strategy. And then looking also at the timeline, this is only a very tentative timeline, but I try to put in something. So if you look at the process going from the initial application, the initial meeting you have, up until the end, which is a shareholder agreement with your new investor, you have to count at least 6 to 12 months before you get there. In some instances, it may even be longer. It may very well be that you meet an investment fund that says, okay, we love your business, but it's too early stage for us. So contact us again in 1 or 2 years when you're a little bit further. So then it can take even longer. But it's safe to assume at least 1 or 2 months in order for an investor to screen your application, to look at it first time, then another 2 months, so that now we are at 4 months to evaluate your project. And they will typically go to an investment committee to get like a preliminary approval. Do you agree we look into this company further? Do you agree we do a due diligence? And that's typically at 6 months, let's say. And then if there's agreement on that, then we'll go towards a term sheet. Term sheet is basically a document where you agree on the main points of the collaboration, of the partnership. And then in a shareholder agreement, that's basically the contractual form after the lawyers have done their work, a translation of the term sheet in terms and with the final issues and questions to be addressed. And then last, it's very important that you pick the right investors. I've always trusted my gut feeling a lot, and even if I knew that a certain person had quite a lot of money available, sometimes I walked away from deals because I didn't feel comfortable with the person. So that's really an important one. These are people that you will see on a regular basis as the shareholders, and if they're investing considerable amounts, they will be involved in the board as well. So these are people that you will have to talk, negotiate with the whole time. So if you feel that they are not fully in line with your vision about the company, then don't make any compromises. Just wait a bit longer then until you meet the right person, because this person will have a big impact on your happiness as an entrepreneur. And if you have people that fully support you, fully believe in you, share your vision, and it's so much nicer to work with than with people who just look at you, who have been skeptical from the start and who are challenging you on every decision. That's really a world of difference. And then also, very importantly, investors are like sheep. So it's really a matter of being able to close a deal, convince one person who follows you, and then use that motion, use that momentum to convince others. That's a strategy that works really well, because they look at each other and they say, wow, this one has invested in it, or he probably has done a good due diligence, or he knows the industry, he knows the business. So if he's investing, then it gives me, as an investor who knows the business less, it gives me more confidence. And that's the example that I cited earlier. Our first investor was actually the former CEO of a recycling company. So by the fact that he invested, it created a lot of confidence with investors that don't know the recycling business. They know the guy knows what he's talking about. Big investors who don't only bring in money, but also experience and knowledge. We've already talked about it. I think looking back, that's possibly the biggest assets from my shareholders, because the money that they bring in is easily spent, but the expertise they bring in is something that that you can continue to leverage on. And also make sure that you select the right investor. If you know that if you're in it for the social impact and you're not aiming for big profits, then don't waste your time in talking to private equity funds, because these guys will typically expect 20–30% return per year. And in my experience in the recycling business, it's almost impossible to get these kind of returns. So, you know, you are in a business where you are doing a good thing for the environment, so use it in a positive way and target funds or organizations or persons that you know have an affinity to the environment, and who won't only look at your financial figures, but who will also look at, you know, the amount of waste that you've cleaned up and the number of people you are employed, or let's say the social opportunities you've given to some of your collectors or some of your dismantlers. And then also, if you found the right person, pick the right terms. Valuation is important. Be clear on what they expect in terms of return on investment. Make sure that everybody is not expecting to receive a dividend as of the first year, because then you will have complaining for the next few years going on. And set realistic expectations. I typically say the first 4 or 5 years, we won't be distributing any profits. We need to grow as a company, and investors usually accept that. They know that the company needs funds to grow. So pick people who can live with that also. And then what will be typical, what will be the typical parameters of a deal at seed stage, which is probably the stage where most of you are, giving an investor between 30 to 50%, or your other investors in total, 30 to 50% of your company. They will typically want preferred security. So that means if you go bankrupt and that you agree that they are paid first before the others, they will typically also look for anti-dilution protection, so that you cannot just increase the capital so they don't have anything to say anymore in the company. And depending on the amount they bring in, they will want a seat in the board, or they will want certain veto rights on certain decisions. And that brings us back to the topic of the control of the company. The arrangements that I've been able to negotiate is that within the board, the founders always have 50% of the majority. So we can basically decide everything, but that for the key decisions, being the approval of the business plan or large investments above a certain amount, there you need this explicit approval from the other board members. And that's a good way of working, so that you don't need 4 people or 5 people to agree if you want to buy a new truck or something, as long as it is mentioned in your yearly budget, in your yearly plan, and it's been approved, that you have let's say, you can freely execute your operational plan. For a convertible debt, it's typically an interest rate between 5 and 8%, a loan on 2 to 10 years. And then if they convert, so it means if the loan is converted into shares, it's always at the future valuation minus a discount. So typically 20 to 30%, so that they're also doing a good deal compared to other investors stepping into that phase. And then last but not least, if you're negotiating, try to negotiate with multiple parties. It increases your bargaining power. Even if you already know that you don't want to go ahead with this or that party, just the fact of being in negotiations with them makes your negotiation position stronger. And also let them know that others are interested and you're talking to others. Never tell names unless you have to, because then you risk that they start talking to each other. But say that you're talking to others, you've signed a confidentiality agreement with others, and so on. And also be smart. A negotiation is always a matter of giving and taking, and to have a good negotiation, everybody needs to be happy. And being happy in a negotiation means that, okay, you've conceded on some points and you've won on some points. So anticipate on that and make sure that you are prepared to concede already on a few points and focus your efforts on other points that are more important to you. So in my case, for instance, I've been a bit more flexible about the valuation, but I've never given up on I've always made a point of being persistent on control of the company in order not to be blocked by external investors. So that's it from my side. I hope this information has been useful to you.